Well, hello everyone. My name is Jason Nord. I'm the TIF Division Director. Okay, well, we can get started here. TIF is a complex topic, but this presentation is meant to give a broad overview and introduce or provide a refresher on some key concepts. This training is one sub-portion of what we formerly used to present as part of half-day trainings for TIF authorities and counties. And we do have a county administrators TIF training webinar that's targeted to county auditors and their staff that is scheduled for next Tuesday, July 25th. If it'll also be released as a video thereafter if you can't make it live. We've historically done the county sessions in odd numbered years and targeted authorities in the even numbered years. You can find last year's authority video out on our website. There were also some big law changes in 2023, mostly geared to cities and authorities more so than the counties. And we'll be having an upcoming webinar on the new laws that we're going to announce soon. And we're also going to post a couple of videos on the 6-year rule coming up soon and some of the changes that were made in the 2023 session. So look out for those materials. Okay, well, let's begin with the basic question, what is TIF? TIF is different things to different people. It's a public financing tool for businesses and economic development professionals looking to initiate development projects. It's a revenue type or fund to finance directors and accountants who handle the financing activities. It's a feature of the property tax system for county auditors and affected taxing entities. And for all involved, including us as oversight administrators, it's a statutory program. And so maybe the key takeaway is not to be limited by your own perspective or duties, and to understand that there are laws and limitations and compliance components that do need to be understood. And this is especially true for TIF authorities making use of TIF. And so someone for each TIF authority should try to have their eyes on the bigger picture and understand the bigger context, and hopefully this presentation will help with that. Okay, tax increment financing, or TIF, we have a good definition here for you, is a financing tool where new value from a development is captured from the tax base so that the property taxes on that new captured value, i.e. the tax increments, can instead pay qualifying costs that enable the development to occur. We'll unpack all of that. It's kind of a mouthful, but quite simply, as the illustration here shows, the new value created during the life of a TIF district does not become part of the tax base until after the TIF district ends. So while the TIF is active, only the original value is part of the tax base, and the taxes on the new value get segregated to finance the development. So, and as we go along here, we'll take a look again at each piece of this definition. First, though, let's look at who uses TIF. The municipal bodies that use TIF are referred to as TIF authorities. In 2021, 385 authorities filed reports for 1,668 TIF districts. And there were 2 authorities that failed to report for 3 districts and are subject to having their increment withheld for not getting the reports in. TIF authorities include nearly all cities over 5,000 and a large number of small cities. TIF was also used in 2021 by about a dozen county entities, and those are shown on the map. The map doesn't reflect, there's a few multi-county entities. We didn't include those on that map. 62% of districts created by these authorities are located outside of the metro area. So most of the districts are actually outside the metro, but 81% of tax increment generated is generated in the metro. And I think that's because values are higher and larger projects are more common in the metro area. The term TIF authority derives from the fact that municipal bodies get their authority to use TIF and to undertake various development projects from various development acts. The most common TIF authorities are cities and city entities like port authorities, economic development authorities, or housing and redevelopment authorities. But county and multi-county HRAs, rural development finance authorities, and one large metro township can also be TIF authorities. The Development Acts listed for each of these governs how projects can be undertaken. The TIF Act does not authorize projects and the use of TIF. It regulates how TIF works and how it can and cannot be used. So it's important for TIF authorities to be well versed in the laws that authorize and govern the use of TIF. And unless there's a specific statutory authority for a type of local government entity to use TIF to undertake a development, those entities cannot be TIF authorities. So logistically, the Development Acts govern project areas in which broader development activities occur beyond just the TIF-supported developments. Sometimes, and actually quite often, they're coterminous with the city boundaries. And TIF is used more narrowly by creating TIF districts that consist of the parcels on which the finance development will occur. And there can be many TIF districts within a single project area. Districts are where the increment is generated and where most of the increment must be spent. But understand that some increment can be spent outside the TIF district, but within the larger project area. And we'll talk about that more momentarily. You might notice that TIF authorities name TIF districts in a manner like TIF 1-3 or TIF 2-1. Generally, that first number is referring to the project area, and the second number is referring to the TIF district in the project area. So like TIF 1-3 might be the third TIF district in project area number 1. And not all TIF districts get named that way, but that's a pretty common convention. So the relationship between project areas and TIF districts raises an extremely important TIF concept called pooling. When increment is spent outside the district and in the project area, it's called pooling. And that's not a statutory term, it's just kind of a term in common usage. The idea being that funds from multiple TIF districts can be pooled to fund various project costs. Although we do call it pooling even if there's only one district involved. So just think of pooling as being out district spending. There's an overall pooling limit of 25% for redevelopment districts and 20% for all other types of districts. Although there's also an option for an authority to elect in its TIF plan to pool an extra 10% for certain affordable housing purposes. So that can expand a little bit of the pooling. Two provisions that sought to focus TIF usage and to promote early decertification are referred to as the 5-year rule and the 6-year rule. The 5-year rule defines costs that are obligated after the first 5 years as being out district and having to fit within a pooling limit. I'll get into the rationale later, but it's important to understand that expenditures inside the district are only considered in-district costs if they're spent or obligated within that first 5 years. So the 6-year rule then generally means that districts have to be decertified when sufficient increment is received to pay in-district costs and obligations. And this drives a lot of early decertification. And there were big clarifications and changes to the 6-year rule in the 2023 session, which our office had actually proposed. So that'll be the subject of upcoming videos and webinars. There are 5 statutory types of TIF districts in Minnesota, each with their own requirements and limitations. Redevelopment, housing, and economic development districts make up 97% of all TIF districts. There are also renewal and renovation districts and soil condition districts. And there's some laws over the years that have created districts for limited situations. Like, for example, there's a housing transition district that was authorized for 4 cities, and there was a distress rental property district that was authorized for 1 city. Those narrower uncodified laws are not included in the TIF statute. So there are some uncodified districts. And then there's one type of subdistrict, a hazardous substance subdistrict, that can be created within one of the normal district types to capture additional increment to address the remediation of hazardous substances that might be encountered in the development process. As you can see here, redevelopment and housing districts can each collect increment for 26 years. Economic development districts are limited to 9 years of increment, given there's more debated policy justification for those types of districts. And renewal and renovation districts are limited to 16 years, and soil condition districts can collect 21 years of increment. So redevelopment and renewal and renovation districts are similar in that each requires meeting a blight test, where the authority must find that certain conditions exist. For redevelopment districts, parcels consisting of 70% of the area must be occupied by buildings, streets, utilities, paved or gravel parking lots, or other similar structures, and more than 50% of the buildings, not including outbuildings, must be structurally substandard to a degree requiring substantial renovation or clearance. And alternatively, there's also certain rail properties, tank facilities, or qualifying disaster areas that can qualify for a redevelopment district. For renewal and renovation districts, the same 70% coverage test must be met, but only 20% of the buildings need to be structurally substandard, and another 30% of the buildings must require substantial renovation or clearance to remove existing undesirable land use conditions like incompatible uses, overcrowding, or other land use hazards. So for both of these district types, 90% of the tax increment revenue must be used to finance costs of correcting such blight conditions. Economic development districts must be found to be in the public interest because they discourage commerce, industry, or manufacturing from moving operations to another state or municipality. They increase employment in the state, preserve or enhance the tax base of the state, or they satisfy the requirements for a workforce housing project. These districts are limited, however, to certain uses. No more than 15% of the square footage of buildings and facilities may be used for a use other than manufacturing, warehousing, storage and distribution, research and development, telemarketing as the exclusive use, tourism facilities, which must meet certain qualifications, space necessary for and related to these uses, or for workforce housing projects. And again, those projects also have certain qualifications. So generally speaking, economic development districts are not meant for commercial and retail developments. Those activities should generally depend on the existence of a suitable market and are not as footloose as the qualifying uses. But there is one exception for small cities. Those cities that are less than 5,000 in population and are located 5 or 10 miles plus as the crow flies from a city of 10,000 or more. The requirement had always been 10 plus miles, but that was changed this session to be 5 plus miles for new districts going forward. And so these small cities that qualify may assist a commercial retail facility up to 15,000 square feet, but increments may only assist that facility and be used for admin costs. That they may not be used for pooling for other purposes. Housing districts are for low and moderate income projects defined in either federal, state, or municipal law and are aimed at increasing the supply of affordable housing. Tax increment from these districts may solely finance the cost of housing projects or pay related administrative and public improvement costs. And because such housing developments are generally considered in district, even when they're located outside the boundaries of a TIF district, pooling limits generally are not applicable in housing districts. A small portion of the buildings may be used for non-residential uses like a street level shop in a multi-story housing complex, but those other uses are limited to 20% of the square footage of buildings. There are income limits that apply to qualifying projects. For owner-occupied housing, the initial purchaser and the initial occupant must meet requirements for a qualified mortgage bond project as defined in the Internal Revenue Code. And generally, those projects require the income to be less than or equal to 115% of the area or state median income. For rental housing, properties must meet the requirements of a qualified residential rental project, again under the Internal Revenue Code. And those projects can generally meet one of two tests, where either 20% of the units are occupied by those with incomes less than or equal to 50% of the area median income, or 40% of the units are at 60% of the area median income. And if you're making use of the MHFA Challenge Program, those income limits may substitute for those projects. Soils condition districts may be used when an authority finds hazardous substances, pollution, and contaminants that require removal and remedial action, and where the estimated cost to correct those conditions is greater than $2 per square foot. A development action response plan must be approved by the Minnesota Pollution Control Agency, and a tax increment may only be used to pay acquisition costs, removal and remediation costs, and administrative costs. The hazardous substance subdistricts are kind of similar, but they're generally used within one of the other types of districts when pollution and its additional costs are encountered. And it is for parcels that are designated as hazardous substance sites, along with contiguous parcels. So the authority must find that development or redevelopment would not occur through private investment or other increment, that any contiguous non-designated parcels are expected to be developed with the designated hazardous substance site, and the subdistrict is not larger than and will not collect additional increments longer than is necessary to cover the additional costs that were caused by these sites. These subdistricts also require a PCA-approved development action response plan. The subdistricts create additional increment by reducing the original base value. Generally, it's reduced to zero, and the additional increments then may only be used to pay costs for removal and remediation, pollution testing, demolition and soil correction, insurance and liability protection, and administrative and legal costs, including costs related to the PCA or the Attorney General, which might get involved in holding the polluters accountable. Okay, before we get back into the components of our definition, do we have any questions so far?
Nope, I haven't seen any yet.
Okay, and so maybe we're giving people time to think a little bit here. Let's do a quick quiz. So Haley, if you could launch our first poll question. That question is, the income limits for housing districts apply only to the initial occupant for A, owner-occupied housing, B, rental housing, C, both, or D, neither.
And it looks like the majority of people said both.
Oh, okay. Interesting. The correct answer is actually A. It's only for owner-occupied housing that the income limits apply to the initial occupant. For rental housing, it's a continuous requirement that those income limits be met for the full duration of the TIF district. So it's only for the owner-occupied housing where income limits just apply to the purchaser and the initial occupant. So good. Congrats to any of you who got that right. So, all right, well, let's continue here with our definition of TIF and take a look at its various components. We first noted that TIF is a financing tool. So it's worth noting that TIF is not an incentive, or that's a tax break or a tax reduction or a tax abatement. The taxpayers in a TIF district will pay the full property tax on the parcels, even on the captured value. But it's the incremental taxes on that captured value that become a revenue stream that the TIF authority can use to finance the costs that assist or enable the development. Because development costs are generally incurred up front, while the tax increments are collected over the duration of the district, debt obligations are needed and become an important consideration. The most common type of debt obligation, representing 68% of TIF debt reported for 2021, is a pay-as-you-go or pay-go note, where the authority has an agreement to reimburse the developer, owner, or note holder for qualifying costs that the developer or owner incurred or separately financed. These have become more popular over time because the risk is not borne by the TIF authority if the actual increments fall short of projections and become insufficient to pay all of the costs. Um, General obligations or GO bonds um, are still being used, but they're far more common in the early years of TIF. And with these bonds, the municipality pledges their full faith and credit and must raise taxes to pay off the bonds if increments are not sufficient. With revenue bonds, which pledge only the tax increment revenues or maybe other revenues such as special assessments, um, they're an option, but they're less commonly used because I think they're less attractive to investors who end up then bearing more of the risk. And many districts also make use of interfund loans where internal dollars are borrowed from another fund in the municipality. Usually, though, that's to cover supplemental costs like administrative costs rather than being the sole funding source of the district, although that has happened every now and then. All right, next let's look at the second part of the definition, this notion of capturing new value. Let's look at an example here where a vacant, deteriorated, structurally substandard property before development has a market value of $200,000, and the proposed development would be valued at $3.4 million after development. When a TIF district is created, the authority must request that the county auditor certify the original value of the district for the base year. Any new value in subsequent years, which is measured as the current value minus the original, will be identified as captured value. So with our example, here we see the market values on the left and the equivalent net tax capacities or NTCs on the right. NTCs being the values that are used for property tax calculations. And so as a quick aside, the terminology of net tax capacities may be familiar to most, but not all of you. And if you're new to Minnesota's property tax terminology, it might strike you as a confusing term, and you might wonder why the amounts seem oddly small compared to the market values. It's named this way because in 1988, the legislature decided to define values to be in similar proportion to the desired effective tax amounts, and thus its name comes from the desired net tax capacity. So the thinking was that high and low tax rate areas could be judged by how close the tax rate was to 100%. And the concept never really turned out, I think, like it was envisioned. But nevertheless, we have this odd terminology that no other state has. And most other states might just refer to this as assessed value or taxable value. And we have values that are expressed as small amounts and rates that are expressed in large percentages. But anyway, getting back on point, for this example, the TIF district is comprised of a parcel that had a base year market value of $200,000 or $3,250 in net tax capacity. And then after the development, the current market value is $3.4 million or $67,250 of net tax capacity. So $3.2 million would be the captured market value, and there's $64,000 of captured net tax capacity. Captured value is not part of the tax base, meaning it's not used to calculate the tax rate or to generate any of the local tax levies. The tax rate, though, is still applied to that captured value, and that's what yields the tax increments that finance development costs. So before continuing, one more quick aside for those of you that may be tuning in to learn about TIF as a feature of the property tax system. When we talk about capturing tax base, it should be noted that there are different types of property tax bases. To describe this very briefly, property taxes are generally the result of a value times a rate. And the value starts with the assessor's determination of estimated market value. However, there are the existence of exemptions, exclusions, and value deferrals means that not all property is taxed at its full market value. So taxable market value actually becomes the starting point for two different types of tax bases. The net tax capacity is the main tax base for most property tax levies. It's determined by multiplying that taxable market value times a class rate based on the property type, like homestead or commercial. And these are small percentages, like 1% for homesteads. And that's how the values are more comparable to tax amounts in terms of their order of magnitude. Some property taxes, however, use the different tax base called referendum market value. Referendum market value typically equals the taxable market value or a portion of it for select classes of property. So, like for example, farmland is not subject to referendum market value levies. One more wrinkle here, the state property tax is levied on net tax capacity, but only for certain property types. So the county tax systems will distinguish between the local net tax capacities and the state net tax capacity as two separate tax bases. So it's important to know that TIF only captures value for local net tax capacity based tax levies. It does not capture the state net tax capacity or otherwise affect the state property tax levy, and it does not capture or otherwise affect any local referendum market value based levies. Okay, this brings us back to the next part of our definition
Hey,
where we say,
Jason, before
sure,
you move on, there were a couple of questions about when you were talking about TIF financing.
sure.
Um, there's two different questions about interfund loans. One is, can the county or city charge interest on an interfund loan?
Yeah, I don't think there's any prohibition on interest on interfund loans.
Okay. And then the other question, are there any specific monetary limits imposed on interfund loans?
Um, no, there's no specific maximums or thresholds. No, not that coming to me off the top of my head anyway.
Okay, that's it.
Okay, very good. All right. So we're onto this again. We're onto this next part of the definition, and we've said that the tax rate is applied to captured value, and that's what creates the additional taxes above the local levy amounts. So, so that's an important concept. To illustrate using our example, the base value that will help support local levies will basically remain just the original value of that $3,250 for the full duration of the district. So, from the perspective of the taxing entities that are looking at their tax bases that can support local levies, it's as if the development hasn't happened, and that $200,000 building is still there. It's and then by applying the city, county, school, and special tax rates to the base original value of 3,250, you might raise total of $4,448 of taxes to support those local levies. But the rate still gets applied to the captured value, and when that's done, the total tax on that captured value, in this case, it sums for all jurisdictions, it sums up to $87,594. This is the revenue that's separately identified as tax increment revenue, and it's distributed by the county auditor to the TIF authority, who must segregate these funds and follow all of the limits and restrictions on the use of tax increment to finance development costs. And by the way, as I was talking there, I did think, our, back to that interfund loan question, there are interest rate limits on interfund loans. And if so, we do have a statement of position on our website about interfund loans. So there are maximum interest rates that do apply on interfund loans. All right. So the implications of this capture of increment and the capture of tax base, there's implications on the tax base rates and levies that should be well understood. Capturing value from the tax base directly affects rate calculations. Tax rates are determined by dividing a jurisdiction's adopted property tax levy by the value of its tax base, which excludes the TIF's captured value. So, for example, let's assume that the city had a total net tax capacity of $1,064,000, and the TIF district has captured $64,000 of net tax capacity, and that leaves the city with a total of $1 million of tax base. And let's assume that the city levied $467,700 of property taxes. So the city tax rate would be 46.770% when calculated using the tax base, which again excludes the captured value. If the TIF district was terminated or not needed, and that $64,000 of captured value became available to support that same levy amount, the tax rate would be 43.957%. So understand that tax increments are additional taxes. Applying the tax rate to the uncaptured tax base raises, or so when you apply the tax rate to the uncaptured tax base, you raise your full levy amount. So when you also apply it to the captured value, you're generating additional taxes. And in this case, it's nearly $30,000 from city taxpayers that are being assessed above the levy amount that was adopted by the city. And this almost $30,000 here is the city's share of that full 87,594 that we saw in the last slide. That larger amount included the school district and special, or I'm sorry, the school, the county, and special district taxes as well. The capture of tax base may also be indirectly impacting judgments about how much to levy, given sensitivity to higher tax rates. So in this example, if the TIF district were terminated or decertified, the city would have a choice to either maybe maintain the same tax rate and uh, or they could raise, they could raise the levy to maintain the same tax rate, or they could keep the levy the same and let the tax rate go down and ease burdens on taxpayers, or they could do something in between. And so you can see how creating new tax base has very positive implications. And if it would not have existed without TIF, then TIF is helping lower rates and enable more revenues in the future. But if TIF is being used to capture tax base that would have existed anyway without TIF, then it has the opposite implications of raising rates and taxes and pressure on levy decisions for the duration of a TIF district. Let me show a model of the TIF concept here that'll help illustrate. So the general premise from its redevelopment origins is that a property might be blighted where its value is declining or stagnating, and this is expected to continue absent any public intervention or assistance. And then when a TIF district is created, the original value at that point is established or frozen as the tax base for the duration of the district. And then with public financing of TIF in place, the development is enabled and the value increases. And again, that rate is still applied to the captured value to generate the tax increments that are not part of the tax levy. And then when the district ends, that's when taxpayers realize the public benefits of the endeavor because the new tax base is available to support local levies. And the capture of value that provided the tax increments is generally viewed neutrally as the investment that made the benefits possible rather than negatively as economic loss, given that the development would not have happened but for the use of TIF. And this but for test is crucial to the proper use of TIF. And statute requires that a municipality must be able to make a finding that, in its opinion, the development would not reasonably be expected to occur solely through private investment within the reasonably foreseeable future, and that the increase in the market value of the site that could reasonably be expected without the use of TIF would be less than the market value of the proposed development after subtracting the present value of projected increments. So in other words, the second part of that is the additional value created by the use of TIF must exceed the value of the investment of increment. But why is the but-for finding so important? Well, in our conceptual model, we started with the premise that the value was declining or stagnating, and that this was going to continue for the foreseeable future absent the use of TIF. But if instead the proposed development would occur without the use of TIF, then the conceptual justification disappears. And when the TIF district is created, the freezing of that tax base for the duration of the district and the capturing of that value to generate increment represents an economic loss, where tax base that could have supported local levies is now instead providing a subsidy to the development. And this illustration is kind of highlights a worst case scenario where the proposed development would happen without TIF. But of course, it's not always going to be so easy to assess what would and would not happen without TIF. The but-for finding, after all, involves some subjectivity. It's unlikely to be perfectly black and white that either no development would occur without TIF or that the proposed development would surely occur without TIF. Judgments have to be made about what would reasonably occur absent the use of TIF over a time horizon of up to 26 years. So perhaps some modest or undesirable development could be expected to occur late in the time horizon, or maybe a nearly comparable development would likely follow quite soon. And then in between, you've got all kinds of nebulous possibilities. So perhaps a more common possibility is where, absent the use of TIF, a different development of lesser value would occur later during the TIF district's timeframe. So in that scenario, the start of the district effectively leads to the higher value development, and the capture of value and increment is neutral until the point at which the value that would have existed without TIF begins to represent an offsetting economic loss because it would have been available without the use of TIF. And in the end, there is public benefit. It's just offset to some degree by that intervening loss. And these models don't account for immediate benefits like jobs and economic activity, but they help illustrate the effects on that taxpayers may experience and the importance of making a studious assessment of the but-for finding. And note that these impacts are not felt by the city or TIF authority alone. While TIF authorities hold decision-making power over the use of TIF, those decisions impact all the local taxing jurisdictions. The county, the city, the school district, and the special taxing districts all see their tax base locked into that original value and don't benefit from the new value until the district ends. One step that is part of approving a TIF district is to give copies of the proposed plans to the county and the school district. And other than one infrequently used option where the county can require some county road costs to be included in a TIF plan, the TIF authority is generally not bound by any of the input that they get back. But taking that into account and giving it due consideration is a dutiful part of approving a TIF district. Okay, how are we doing on questions? Do we have more that have come in?
No. Someone wanted you to state the max interest on a interfund loan again. I did link the statement of position as well.
Okay, yep, yeah, you'll find that in the statement of position. I think it's largely been around 3% for most of the most recent years, but you'd have to look at, there's a table in the back of that SOP that shows year by year what those maximum rates are. So.
Okay. Oh, and I just see a new question here. Who are special districts, and can you give an example?
Yeah, special districts are things like watershed districts, or maybe I think there's like downtown improvement districts. It's basically just districts that have their own tax rate for that can be levied in a certain area. So yeah, I think watershed districts are probably the most common example of that. So, all right, well let's take another quiz here because quizzes are always fun. Hey, Haley, do you want to launch the second one here?
Yep.
And the question is, which of the following statements is true? A, TIF always increases tax rates. B, TIF never affects tax rates. C, TIF's impact on tax rates depends on the but-for test and timely decertification. I'll give you a few seconds here to answer that.
And I am going to close that. So the vast majority of people said that TIF's impact on tax rates depends on the but-for test and timely decertification.
All right, very good. That is correct. Haven't really talked yet about timely decertification. That's another component. We'll get to that coming up here. But yeah, TIF is either great or awful, or it can be good or bad depending on that but-for test. So it's all about how it's used. All right, well, let's continue on and get back to our definition here. There's one more detail that I wanted to cover regarding the identification of tax increments. Property taxes are not just the value times a tax rate. There are also credits that might reduce the gross tax to the net tax that a taxpayer must pay. And gross taxes includes both tax increment and regular taxes. So a credit proportionally reduces both the levied taxes and the tax increments. And so when credit reimbursements are paid by the state, you may see that them identify the TIF share of the credit versus the rest of the credit. And so most credits don't apply to the types of properties that are usually found in TIF districts. there's not a lot of credits on commercial industrial, for example. So you don't see a lot of these credit reimbursements. Generally, the Department of Revenue makes those reimbursements. And for 2020, they only listed 11 TIF districts in 8 counties. And other than people receiving disparity reduction credits, the amounts of those credit reimbursements were quite small. So for many of you, you may not see TIF credit reimbursements coming in. But if you do see that, just be aware that that's part of your tax increments, and you need to identify and segregate that as part of keeping track of your tax increments. Okay, so the next part of the definition then is that increments are used to pay qualifying costs that enable the development to occur. Qualifying costs might include things like costs for land acquisition, demolition, utilities, streets, and sidewalks. TIF is meant to be an enabling tool that helps to address market failures or costs that serve as obstacles to free market activities. And that's easy to see in the case of redeveloping blight. But with housing, developers tend to focus on market rate development. And generally, in order to get affordable units, there needs to be some incentive. And the case for economic development districts is a little bit subject to more debate. But the reality is that some sectors like manufacturing and warehousing and other industries, they can be really competitive and footloose, and they can locate in a wide range of locations. So subsidies do become an important factor in being able to locate those. As we've seen, looking at the conceptual models and the but-for test, TIF is not meant for developments that are likely to occur without the need for its assistance, or for costs that are unrelated to enabling those developments. So one consideration for a TIF authority then is to think about right-sizing the use of TIF or using it to the proper extent. In our prior example, we saw that capturing $64,000 in net tax capacity raised the 87,000 plus of tax increments in 1 year. And for a redevelopment district, which can collect increment for up to 26 years, that could generate close to 2.3 million over the life of the district. But what if you only need $1 million of assistance to make the development possible? This raises the consideration of examining the extent of the costs and the activities that you should include in a TIF plan. So without getting into all the required elements of a TIF plan, there are certain estimates that do need to be included in a TIF plan. A TIF plan must contain estimates of bonded indebtedness, the original net tax capacity, captured net tax capacity, and its duration. But more importantly, the TIF plan must contain 3 separate estimates that set the total authorized costs for a TIF district. It must separately identify the cost of the project for things like acquisition and site improvement costs, and that includes administrative costs. Interest as a financing cost, and the tax increments to be generated over the life of the district. These 3 estimates establish the total authorized costs or budget for a TIF district. And the total of the project costs and financing costs that are going to be paid with tax increments cannot exceed the total estimate of tax increment revenue. So setting appropriate TIF plan estimates becomes an important consideration. Some might advise maximizing the estimated costs to enable the maximum expenditure of increment as a revenue source. Or is it better to minimize those expenditures to what is necessary and then terminate the district as early as possible and reap the tax-based benefits? Another initial consideration is deciding whether to set an earlier duration limit than what is allowed by statute. 26 years, for example, may be far too long to tie up tax base if the necessary costs could be financed in 10 or 12 or 15 years. And there's also an opportunity to share captured value or just monitor things and decertify early. And let me explain this last bit a little bit more. An authority has a seldom used option that it can share rather than fully capture the new tax base. So in this scenario, if from our earlier example, if 20,000 of that $64,000 captured net tax capacity were shared instead of being retained as captured, Then the frozen base is essentially raised to include some of the new tax capacity and represent some immediate public benefit that would be enjoyed for the duration of the district. But the risk here is whether the diminished tax increments on the remaining retained captured net tax capacity would be sufficient if the growth in value ends up being less than projected due to the actual scale of development, market conditions, or legislative changes that might impact property taxes. And that's very common that the reality doesn't match the expectations. So this is why most authorities choose not to share value, and a more attractive option may be to decertify the TIF district early once the captured increment has been sufficient to cover all the necessary costs. So this is consistent with what the 5-year rule and the 6-year rules are intending to accomplish, where the intent is to identify core in-district costs in the first 5 years and then decertify once sufficient increment is available to pay those costs. The idea is to limit capture to what is needed to achieve the early decertification and then enjoy the benefits of that expanded tax base as early as possible. So early decertification is actually very common. Based on decertifications that occurred for the last 5 years of reporting, 2017 to 2021, 78% of redevelopment and housing districts decertified early, and not just early by like a year or two, but on average by like 9 or 10 years. And even economic development districts, which have shorter durations, they still decertified early 38% of the time. So early decertification has grown to be the norm, and it's been increasing as a percentage as well. Sometimes we encounter municipalities that delay decertification and try to hold on to surplus revenues, or they want to keep the stream for more expenditures, particularly for more pooling, for out-district costs, or more administrative expenses. However, as we've seen, decertifying early maximizes those tax-based benefits. And when unused tax increments are returned to the county auditor, they are distributed back to the county, the city, and the school district in proportion to their tax rates. So those redistributions of returned increments are free of TIF restrictions and can be used for any municipal priorities. So there's sometimes this false notion expressed that returning increment is giving it back to the state, but that is not the case at all. And it's wise to think broadly and consider the impact on all taxing jurisdictions, not just on the municipality. All right, at this point, we've largely completed the overview of the core concepts, but I do want to get into a little bit of brief history, grounding in history, and some final thoughts. But before we do that, how are we doing on questions? Do we have any more?
Nope, I haven't seen any more questions.
Okay, so we got one more poll question here to launch, the simpler true or false question. TIF districts usually last their full duration or end just a year or two early. Is that true or false?
I will go ahead and close it. A little more than 75% said that was false.
Good. Yeah, that is correct. Most districts are actually decertifying early, and when they do, it's more than just by a year or two. It's usually by quite a bit. So that's good. All right. So a brief history here will provide some good context. TIF originated nationally after World War II to address urban blight, and it was meant to make redevelopment competitive with sprawling development. And the use of TIF for housing and economic development were ideas that expanded later on. The TIF concept was actually first included in Minnesota statute back in 1947, but it was essentially ignored and considered inoperable until it got incorporated into the various development acts that we looked at earlier, and that happened from like 1969 to 1974. So early usage during that time frame struggled a little bit because there were differences between the different acts, and there were some issues with trying to operationalize TIF. And so the TIF Act was enacted in 1979 to bring order, clarity, and to put some real basic limitations in place. Let's look at its timeline in Minnesota here. So as TIF began in Minnesota, there was substantial early growth. The number of cities went from 4 in 1974 to 57 by 1979. and increment went from 400,000 to 7.4 million. And counties and state legislators began expressing some concerns in that time about the impact that these TIF districts were having. And there were also all the operational questions. So the 1979 TIF Act brought uniformity and clarity as to how TIF was to work, along with some basic limitations. And then this clarity of process, however, actually resulted in massive growth. And the concerns of counties and legislators grew with that. And then in 1988 to 1990, there were these major new limitations that were imposed on TIF. Um, and although growth continued, it did so at a more moderate pace. And TIF continued to receive scrutiny from the legislature. And then in 2001, there was tax reform that had two major impacts. First, it reduced class rates for commercial industrial property, which cut the amount of captured tax capacity by 30%. And then the state takeover of general education levies also largely eliminated some of the concerns that legislators had had about school aid interactions. So with that change, then TIF no longer was seen as driving up school aids, and legislative scrutiny waned a bit, although moderate growth continued. And then changes in the TIF Act have been much less frequent since then. By 2008, though, the amount of tax increment peaked and began to decline as a wave of decertifications began from that original surge of district creations. They started hitting their maximum durations. And so the amount of districts in increment has been declining. And then in recent years, it looked like we were leveling out and maybe reaching an equilibrium. But we have seen over the last couple of years a little bit of resumed growth before the drop last year. Now, in this course, we're not going over all the restrictions on TIF and all the limitations that an authority has to be aware of. And this slide isn't something that you need to digest. It's just offered here to visualize kind of the scope and the history of the different provisions that have come about. You can see that the TIF Act incorporated the but-for test and the need to return increment in excess of the authorized costs and duration limits and limits on admin costs and a few other provisions. And then you can see the reforms added a whole bunch more. Arguably, the biggest problem in the early years after the TIF Act was using pooling and plan modifications to really expand the scope of TIF districts and to spend all increment generated over the full duration of a district well beyond the original proposed developments. And to address that, the overall pooling limit of 20 to 25% of total increment was imposed, as well as the 5 and 6 year rules, which again try to identify the necessary costs as those in the first 5 years, and then to require decertification once those costs are paid. And then this past session, we saw a set of significant changes amounting to the biggest changes since the 1990 reforms. So the OSA, we put together a group of stakeholders to discuss clarifications and improvements that we felt were needed to address a lot of the ambiguity that was kind of hindering people's understanding and hindering people's ability to comply with and hindering our oversight of the various TIF laws. So the biggest changes were clarifications and changes made to the 6 year rule and some of the other pooling provisions, along with a few changes and clarifications related to administrative expense provisions and some clarifications of the statutes that dealt with TIF Act violations, as well as a few other miscellaneous changes. So given the scope of restrictions, limitations, and other legal provisions, getting legal advice or professional advice is a good idea when you're using TIF. There are legal considerations not just in establishing a district, but in the ongoing operation. Provisions may require actions like returning increment, decertifying early, providing notifications, addressing errors, proper reporting, and remedying violations. And beyond the legal compliance issues, generally, there's a significant amount of administrative commitment to using TIF, and it's one that can last for 26 years or more. It's a long-term commitment to segregate and track funds, to monitor legal compliance, to maintain and retain documentation, and to complete reporting obligations. So municipalities should honestly assess their own administrative capacities and then take good care to establish clear duties and processes to avoid consequences that might flow from poor record keeping and improper activities. So finally, please note that on one of your handouts, which was linked in the reminder email, and Haley, I think, is going to link it here again in the chat, is a document with some resource links. We suggest, for one, that you sign up for the OSA's weekly updates if you haven't already. We email updates every and post them on our website every Friday with just reminders and tips and articles. And also check out the statements of position on our website. Especially that interfund loan one. Um, and look for training videos and articles. Um, and for the county folks that are joining us, we do have a county TIF guide on our website that should be very helpful to you. And there's also links there to the Department of Revenue's Auditor Treasurer Manual, which has some good information about TIF um, uh, that you can look into. So that brings us to the end here. Are there any questions about what we've discussed or things we didn't cover?
We did have one question come in about interest earnings. Let's see. Are interest earnings in the TIF fund included in the remaining funds to be paid back to the county auditor for decertification?
Um, uh, I'm not sure if I fully understood the question, so I'll take another look at it later and get back to you if this isn't what you're asking. But if you are earning interest off, like say you issue a bond and you get bond proceeds and you're not spending them all right away, if you're earning interest on bond proceeds, those are defined as tax increments and have to follow all the rules around TIF too. So if you do end up having extra revenues on hand because of those interest earnings, yeah, you can return those at the end if you don't use them at the end of the life of a TIF district, and those will get redistributed to the county, city, and school district. And once redistributed, you know, no longer subject to TIF restrictions. So we've hit 3 o'clock here, or 3:01 actually. So we'll let everyone go, but we can stay on here and answer any additional questions if people have lingering questions. But I just want to thank everyone for joining us today. Again, county people, look out for the training coming up next Tuesday if you're interested in that. And authorities, please look out for those videos on the 6-year rule and the new laws webinar that we'll be announcing soon. And again, we'll stay online here, but otherwise, have a great day. All
Thanks,
right.
everybody. So I do see a question coming through here. I think it's a clarification. So as the value increases, does the increment doesn't grow?
Yeah, I'm not sure if I understand that. Maybe shoot us an email. We can take a closer look and understand and follow up because we do want to be able to help clarify any questions you have. So yeah, please don't be shy about emailing. But I'm not sure if I quite
I
am
think you
tracking.
might mean, as the value of the development increases, does the increment also grow with that, or does it stay the same?
Oh
Share
yeah,
value.
yeah. So as the current value continues to increase, and that original value largely stays the same, there can be small adjustments that have to be made to the original value when property goes exempt or taxable or changes classification. But for the most part, the original value stays the same. So as the current value grows, then the amount of captured value will grow too, and the amount of increment will grow over time as well. Yeah. So TIF doesn't just capture the construction value. If the market is also causing increases in values, TIF will be capturing that as well.
Okay. And then Brianna is asking, who figures median income in a district, and what if you have both a rural and an urban taxing district with different rates?
Um, that's a good question that we generally don't uh, spend a lot of our time, you know, with the income, the median incomes and stuff like that. I think one of the maybe the best resource for that is I believe the MHFA um, I believe on their website they identify some of those average medians. Otherwise, you may have other resources at your city or county that can help you identify what those limits are. But those aren't we don't we don't look out for and publish those median values. So I myself don't have a ton of expertise on where you can best go. But I believe that the MHFA does um, provide that information.
All right. Well, does anyone else have any questions? I'll leave this open for just a minute or two, but if you do have additional questions, you can always email us or call us. Um, and our number and email is right up on the screen right now. So
Yeah.
I'll leave this open for just a minute or two. So if you want to jot anything down from the chat or look at any of the links that were posted, you can go ahead and do that. And we will send a follow-up email as well with the survey link.
All right. Well, thanks. Yeah, thank you, everyone. We appreciate your interest, and I hope you got something out of this. So, thank you very much.